I think that silver, gun to my head, and I think it's reasonable estimate. We're not just going to see 200 silver. We're more likely to see something like 3 to 500 silver, and probably by summer. Now, during that time, maybe gold only goes up to 8,500, which is to say, does what it did twice before, another eightfold move.
How do you view the Shanghai silver price arbitrage? At least $10 higher in silver
Yeah.
from there to here. It closed today around $134. Can COMEX silver crash as long as that arbitrage exists?
And I don't mean what we saw today or these jiggle that really, you can see it on a monthly chart, for example, not just the daily. I don't think we're there. I strongly suspect that jiggle won't even occur until we get into like later into this coming month or March, and probably at much higher levels than we saw today. But even that jiggle is not the top. It's just a midpoint. We measure the spread relationship between silver and gold. In other words, take an M2 chart and factor its upside increase, do that to silver. Silver would be a couple $100 just to match that.
Silver ripped to 117. It did a hard reverse down to 107. What are you expecting for silver? And are they premature in calling for a top, or is today the makings of a top with that reversal?
Now, there have been umpteen reversals of that percent dimension over the last 3, 4, 5, 6 months. They come, they go. It used to be when silver had those kind of breaks, like back in March through April of 2025, it had a sharp drop from $35 down under 20, no, under 30, excuse me. So it had a pretty big drop percent-wise, okay. And then it came back up again and blew through in the summer, blew through that dual price highs at 35. But that had been a whole year of constant distribution of silver. But the doubters kept, it's topping, it's topping. They kept selling, and yeah, it kept going down, but it kept coming back up. That's not the way silver tops, by the way. But now each time you get one of these events, they tend to be briefer in time. Sometimes they're 2, 3 weeks, like in October. Then suddenly they're 2 or 3 days, like we had about 3 weeks ago. Had a double-digit percent drop then. And then they're 1 to 2 days. And now today it's intraday. Ignore them.
What looks like panic selling is often just compressed volatility showing up late in a structural move. Short, sharp reversals like this usually appear when liquidity thins, not when trends end, and that distinction matters for positioning. As Michael Oliver has pointed out, late-stage bull phases often see faster pullbacks precisely because fewer sellers remain. The key stat here is duration. Multi-week drops have now shrunk into intraday events, signaling exhaustion of downside pressure, not upside risk. Historically, real tops come with expanding distribution, not shrinking correction windows. For investors, this suggests risk management through sizing, not abandoning exposure. What Michael Oliver flags next reframes why these reversals may actually be confirmation, not warning.
Silver is going to a new reality. It's going to do, and we've shown studies on this that have happened in other markets. They're rare events. When a market is confined in a price zone for too long, like multiple decades, not reflective of the ongoing collapse and decay in the real buying power of the dollar. So not reflecting the real death of the dollar, not the dollar versus other currencies, but just the dollar in terms of its real value. They break out. Copper did this in 2005, late 2005 through about mid-2006. It quadrupled in a couple quarters. It lived in a range from 50 cents to $1.50 for like 30, 40 years. And when it broke out, in literally a couple quarters, it quadrupled in price. No specific event for copper caused that. And it wasn't common to all the base metals. It was just copper. Okay. Then lead did the exact same thing in 2007, where it had been in a range for like 30, 40 years. Finally said, I'm out of here. And it quadrupled in a couple quarters. And then after that lived in a new reality, quadrupled the price basically of what had been the old reality.
Markets don't reprice decades of distortion politely, they snap. When assets sit in artificial ranges for 30 to 40 years, the eventual breakout isn't speculation. It's deferred math. As Michael Oliver has noted in prior cycles, these moves rarely wait for headlines or catalysts, which is why copper's 2005 surge blindsided most analysts. The stat that matters is time, not news. Multi-decade suppression followed by multi-quarter repricing. Investors chasing reasons usually enter late, while institutions position early. Silver's setup mirrors that pattern uncomfortably well. And what Michael Oliver emphasizes next explains why this repricing isn't tied to any single commodity story.
Well, silver, why was silver confined in a 50-year range? Well, gold wasn't, copper wasn't, lead wasn't. Well, there's some arguments as to why. Okay, I won't get into those. But once it gets out of that range, it's saying, I'm PO'd. I've been kept back. I'm not in reality. I'm going to a new reality that reflects the ongoing decay in the money unit. My relationship to gold has been too cheap too long, et cetera, et cetera. And it's having a tantrum. Expect that tantrum to be mostly occurred in a couple quarters. A couple quarters measured by what? We measure the spread relationship between silver and gold. That broke out of a massive basing pattern. And when that happened in 79 and happened in 2010, that's when you went berserk in both of those bull markets, where like silver tripled, quadrupled in a matter of handful of months. We just broke out in November. So we're like a month and 3/4 into what is the unleashing. Don't be surprised that it lasts. I'm betting, I'm not betting, I'm analyzing, probably into summer, June or July. There will be a jiggle in the middle.
The silver-gold relationship is quietly saying more than the price chart alone ever could. When silver breaks relative to gold after decades of compression, history shows acceleration, not exhaustion. Michael Oliver has repeatedly highlighted that the 1979 and 2010 spread breakouts preceded the fastest gains, not the end. The key data point here is timing. This breakout is barely weeks old, while past moves ran for months. For portfolios, that argues for patience with volatility rather than reactionary exits. What Michael Oliver points to next is why the so-called jiggle may mislead late sellers.
And I don't mean what we saw today or these jiggle that really, you can see it on a monthly chart, for example, not just a daily. I don't think we're there. I strongly suspect that jiggle won't even occur until we get into later into this coming month or March, and probably at much higher levels than we saw today. But even that jiggle is not the top. It's just a midpoint,
What's the indication that you're looking for that says that jiggle is imminent?
We're looking at monthly momentum of silver. We're also looking at the clock because those spread breakouts were very good clock metrics back in 79 to 80 and in 2010 to 11. When silver has already been in a bull market for years, suddenly it goes ape on the upside. And the signal that warned that wasn't something to do with silver itself. It had to do with the relationship to silver to gold, where silver said, I'm mad, I'm coming out of here. You've kept me down for too long relative to the mama metal. And it went on a tantrum. And again, it went to 6.5% of gold in that 79 to 80 move. And it went from up from like 1 to 2 to 1.5 to 3% in that 2010 to 11 move. We're only at 2.1%.
Mid-cycle pauses often scare out the weakest hands right before momentum peaks. Monthly momentum and intermarket clocks matter more here than daily price swings, and that's where most retail focus goes wrong. As Michael Oliver has explained, spread-driven signals historically trigger upside surges long before traditional overbought indicators flash danger. The hard stat is relative value. Silver remains near 2.1% of gold, far below prior cycle extremes. That suggests room, not risk, for continuation. Investors should treat volatility as structural noise, not trend failure. What Michael Oliver highlights next reframes why overbought may be the most dangerous word in this phase.
So we're hardly overdone. The spread only just broke out 7 weeks ago. So it's not old on the clock. And when you factor in, again, the degradation in the money unit and say, well, silver's at least going to regain its value of what it was in 1980 or 2011 relative to where the dollar real buying power is now. In other words, take an M2 chart and factor its upside increase, do that to silver. Silver would be a couple $100 just to match that.
So early March timeframe would be the clock, and then
Yeah, let's say in
roughly,
a month or so. I'd be
yeah,
looking for
end of February, beginning of March.
I'd be looking for a jiggle there. It wouldn't just be the clock, it would be we look at weekly momentum of silver, week by week momentum action, not so much the price, and month by month, monthly momentum action. And neither one,
Do you think you'll see it before it shows up?
they should give warnings before, and they did back like in 79 to 80. There was a jiggle in the middle where you had not a down month, but like a period where you could plot on one month to the next month to the next where the price was redundant.
The quiet assumption here is that time, not price, is the real signal. Something Michael Oliver has warned markets consistently underestimate. The speaker anchors silver's upside to M2 expansion, which has risen over 40% since 2020, while silver remains far below its inflation-adjusted highs. That mismatch suggests momentum exhaustion hasn't even started yet, despite recent gains. Weekly and monthly momentum matter more than headlines, especially heading into late February and early March when liquidity cycles often shift. For investors, this reframes volatility as positioning, not topping behavior. What comes next is where Michael Oliver hints the real warning signs may finally surface.
So in other words, you could have bought and sold at the same price for a 3-month period, up, down, okay? And in 2010 to 11, there was actually a reversal month. In January of 2010, the buy signal was in September of 2010, the spread breakout. It ran up to January high and reversed. You had a total collapsing month in silver. And you ended up closing that month out, January, the reversal month, something the price chart guys would go crazy about. That's the top, right? Okay. Turned around and went up even more by April than it had in the first part of the move.
This is where surface level chart reading quietly destroys portfolios. A mistake Michael Oliver has repeatedly called out. A violent reversal month looks catastrophic to price-only traders, yet history shows it can be structural consolidation, not distribution. In 2010, silver collapsed short-term, only to rally harder within 90 days, a pattern that punished emotional exits. Media loves labeling tops early because it fits narratives, not data. For investors, this means volatility alone is not risk. Misinterpreting it is. What follows next is where Michael Oliver exposes why false tops trap even experienced traders.
And bullion, silver bullion position also. I think that silver, gun to my head, and I think it's reasonable estimate, we're not just going to see 200 silver. We're more likely to see something like 300 to 500 silver, and probably by summer. Now, during that time, maybe gold only goes up to 8,500, which is to say, does what it did twice before, another 8-fold move. I'm really not arguing that's where it's going to stop, by the way. But even if it just did that, and silver said, hey, I'm going back to 3 to 6% of gold, wow, you're talking hundreds of dollars.
Yeah.
And silver will then have done in dimensionality and in speed what copper did in 2005 to 6 and what lead did in 2007 and say, I'm with you.
Which makes sense because, back in the 2005 timeframe, the China infrastructure boom was just fully raging. And so the amount of copper that was needed was off the charts. And now you have the technology boom that's raging, and the amount of silver that's needed is off the charts. And so to your point on the math side, it really makes a lot of sense.
Price targets sound outrageous until ratios quietly normalize, a dynamic Michael Oliver has tied to past commodity supercycles. If gold merely repeats historical 8-fold moves, silver reverting to even 3 to 6% of gold implies triple-digit prices without speculation. Industrial demand isn't hypothetical. Solar, EVs, and AI infrastructure are driving record silver consumption while supply lags. This mirrors copper's mid-2000s breakout, when skeptics were structurally wrong, not cautiously right. For portfolios, this is about asymmetric exposure, not chasing hype. And next, Michael Oliver points to why speed, not valuation, may shock markets.
Let me ask you this. How do you view the Shanghai silver price arbitrage that's seemingly at least $10 higher in silver
Yeah,
from there to here?
it's
I saw it close today around $134. Can,
yeah.
yeah, can COMEX silver crash as long as that arbitrage
I
exists?
suspect not, but I think I don't get involved. We don't get involved in that sort of analysis. I know these things come and go, like the commitment of traders reports. How much bullion they got in the COMEX vault, in the vaults, all this kind of stuff. These things come and go on the sidelines. The real driver here is one, the vast underpricing of silver for too long in relation to anything, in relation to gold, in relation to the stock market, et cetera. Uh, and the fact that there's a monetary driver under this separate and apart from the specific industrial supply demand deficit problem.
Yeah,
Uh, it's money. People laugh at that. It,
I don't.
you're making a mistake.
I'm
Anyway,
with
and
you.
I think it's going to catch up to Mama Metal, and I think India is even talking about potential monetary. And as the stock markets of the world start to fracture, which I expect to see this year in big ways, probably in the mid-year onward.
The arbitrage headline distracts from the deeper force, monetary repricing, a point Michael Oliver has stressed when paper metrics dominate coverage. Shanghai premiums come and go, but chronic undervaluation versus gold and equities does not. Silver's driver isn't just supply deficits, it's trust erosion as global liquidity fractures and equity risk rises mid-year. When capital rotates defensively, money seeks anchors, not vault reports. For investors, this reframes silver as insurance against market stress, not a trade. And what Michael Oliver signals next is why fractures may arrive sooner than expected.
That's where you're going to get emotion into the markets like you've never seen, because the average guy's already hurting. He's already maxed out his credit card. He's already asking for delays on his tax payments. All kinds of pain things like that are just being ignored. Because why? S&P's up near its high. It's not going anywhere. It didn't go anywhere for 6 months, but fine. I think it's actually going up a little bit more right now, Frank. It wouldn't surprise me, by the way, if the Supreme Court comes in and kicks Trump in the shin over the tariff issue. The market will love that because that'll think, oh, that issue's gone. We're free to rally now. The bigger issues here, the stock market's a bubble. It's going to break. Technicals argue to us it's going to break. It's going to do it subtly, but the public can't take that. And when that happens, that causes ramifications in government policy. And suddenly, oh, that government over there wants to go back currency. No more fiat. Oh, that one did too. Oh. And then suddenly the Western countries, which are lagged to reality, say, hey, it kind of hasn't worked. Fiat currencies manipulating interest rates. Maybe we should go to gold backed. Been there before. Why not?
The market looks calm on the surface, but this part quietly exposes how stretched the average household already is beneath record index levels. As Michael Oliver has warned, markets don't break when people feel good. They break when stress is hidden behind strong charts, and US credit card balances just crossed $1.1 trillion while delinquency rates are climbing. The S&P hovering near highs masks the fact that liquidity is thinning and consumer resilience is fading fast. Policy headlines, court rulings, or tariff relief become convenient distractions while structural pressure builds. This is how bubbles end. Not with panic first, but denial. What Michael Oliver hints at next is why policy reactions may accelerate the breakdown rather than stop it.
And I would just love every time they said that, just circle the silver chart where there was a consensus, just circle it. And every time you had that circle, if you bought it, you did quite well.
Well, we could put another circle around 117 today because
Yeah.
everywhere you look, people are already
Oh, sure.
saying,
Yeah. So, and if in 2 days or a week, we're suddenly 125 and 130, they'll say, well, what do I do? I got
I,
out.
So another narrative, another worry is that the gold and silver price movements are not just reversion to the mean, something that should have happened a long time ago. They've been held down, undervalued, underowned, et cetera. Rather, they are a early warning system that something big has broken and there's major problems coming.
Yeah.
What is your take on that?
Oh, yes, that's exactly what our take is. Gold is, well, the oldest market we're dealing with here, thousands of years. So is silver. Okay. Uh, they tried to interject crypto into the monetary mix, like, oh, here's a new alternative, and that suddenly that ain't working. Okay.
Consensus thinking is usually where timing mistakes get made, and this paragraph highlights how silver rallies tend to punish those who wait for universal agreement. As Michael Oliver has pointed out, silver often accelerates after skepticism fades, not before, and sentiment flips quickly once key levels break. Silver moving from 117 to 130 isn't dramatic historically. It's typical momentum behavior after long suppression. The deeper issue is that metals aren't just mean reverting. They're signaling stress in confidence toward alternatives like crypto and fiat. When the oldest monetary assets start outperforming newer narratives, capital is repricing risk. Michael Oliver's next point explains why this signal matters more than most investors realize.
And plus, when you run spreads of Bitcoin versus gold, it's collapsed. And silver, you should see it. It's like an implosion. And they broke down about 4 or 5 months ago, even before price did. But there is an underlying reality, and it's not just in gold and silver. It's not just silver industrial demand. It's the monetary factor. And we've had like a century now of the central banks, what's 110 years on the Fed, something like that, uh, manipulating the price of money, meaning interest rates, at literally government edict, okay? Not a free market, and it's an essential commodity of human interaction, the currency that we use to buy and sell things, okay, between us and the guy you don't even know on the other side of the world, maybe, and hopefully that you're giving him money that actually holds its value. And he's getting what he thinks, and in 2 weeks it doesn't decay. But anyway, that's controlled by governments now, not free market pricing money, and they determine the quantity. That's like a government, in China after Mao, about 20, 30 years later, who was it? The guy who followed him privatized agriculture because they had a monopoly on the quantity of grains and the price of grains, and it wasn't working. And when they privatized that, hey, it worked. And they've since privatized a lot of things.
This section cuts to the core issue most market debates avoid. Money itself is no longer priced by a free market. As Michael Oliver has noted, when Bitcoin to gold spreads break down ahead of price, it signals a shift in trust, not just volatility. Central banks setting interest rates by policy rather than supply and demand distort every asset class downstream. History shows monopolized pricing systems eventually fail, whether grain in China or money today. For investors, this means diversification isn't about chasing returns, but protecting purchasing power as confidence erodes. Michael Oliver's next insight explains why monetary control failures surface first in metals.
But we still have government monopoly over the quantity and pricing of money. It's not working. And when you break the stock market and people start to hurt again, because that's the only thing they got to smile about, unless you're in gold, is, hey, my retirement account's up 15% last year, if they match the S&P, if they were lucky enough to match that. And, if all of a sudden, middle of this year, you've wiped out last year, and then that's like 5,800 we wiped out last year on the S&P, so about, we're 68 and 69, so not a huge percent drop. You'll have wiped out all of 2025, and the guy with his retirement account is late on his credit card and wants to retire. Suddenly his retirement account just dropped 30%. What about the emotion there? What are the political consequences of the desperation of, hey, I thought voting for this party was going to cure that stuff. Nothing works. And when you throw your hands up in the air, nothing works. It has wave effects, not just emotional, but in terms of response time in markets. Things speed up. So an incremental solution to this bubble problem is probably not going to be incremental. And I think the monetary metals know that. And they know this time around, even Jamie Dimon has been saying for months now.
This part exposes the fragile psychology, propping up modern markets more than any valuation metric ever could. As Michael Oliver has emphasized, markets don't need crashes to cause damage. A 15 to 20% drawdown can erase years of confidence when households are already leveraged. If the S&P simply revisits prior levels, retirement plans built on recent gains unravel fast. Political frustration, not fundamentals, becomes the accelerant, forcing reactive policy decisions. When faith collapses, responses speed up and overshoot, creating volatility rather than stability.